Dokshi sir, can we start the session? Dokshi sir,
Yeah, fine.
can we start the session?
Yes, just give me a moment.
Yeah. Good evening all. Myself CMA Vinayak Kulkarni along with CMA Ashish Bhavsar welcome you all for the series of webinars on income tax. The topic for the today's session is income tax assessment and refund. The speaker for the today's session is CMA Dakshit Sokshi sir. I welcome our today's speaker, CMA Dakshit Sokshi sir. Sir, over to you.
Yes, my screen is visible?
No, sir.
No, just give me a moment. स्क्रीन विजिबल क्यों नहीं થઈ રહ્યો?
Earlier it was visible, now it is not visible.
Now it's visible?
Yes.
Hello?
Yes. Yeah.
Right. So good afternoon, everyone. Today's topic is assessment under Income Tax Act. Second. So what is assessment? As we know, every year we are required to file the income tax return. So for all the taxpayer, filing of income tax returns is a yearly ritual. How the department or income tax department will come to know about our income? It is through our return, which we file. So every taxpayer has to furnish the details of his income. And this is how the income tax department will come to know what is our income. So the process of examining the return of income by the income tax department is called the assessment. So once we file the return, that would be examined by the income tax department, and the process of examining the return filed by us is the assessment. So we can say that income tax assessment is the process of collecting and reviewing the information filed by the assessees in their income tax return. So what could be types of assessment? Under the Income Tax Act, there are various types of assessment. First and foremost is self-assessment tax, which is under section 140A. Then comes section 143(1), that is called summary assessment. Then we have got section 143(3), scrutiny assessment. Then we have got section 144, that is based judgment assessment. Then we have got section 147, which speaks about income escaping assessment. Then we have got section 153A and 153C, which speaks about the search assessment. And we have got section 144B about faceless assessment. In this, as we are going to have a special session on the faceless assessment, in today's webinar, we would be covering all types of assessment except the faceless one. So let's first understand the first and foremost, what is self-assessment tax? Self-assessment tax is specified under section 140A(1). Now, I think my presentation is visible. Hello?
Yes, sir.
Okay, fine, great. So in this presentation, I have also tried to include the relevant sections. So whenever the relevant sections would be appearing in my presentation, that would be in the italic form and that would be in the brown color. So section 140A1 says that where any tax is payable on the basis of any return required to be furnished under sections 115 WD or 115 WH or 139 or 142 or 148 or 158 or 158 BC as the case may be. So what the SSC would do, the SSC after taking into account the amount of tax which is already paid under the any provisions of the Income Tax Act. Now, any tax deducted or collected at source, any relief of tax or deduction of tax claimed under Section 90 or 91 on account of tax paid in a country outside India, any relief of tax claimed under Section 90A on account of tax paid in any specified territory outside India, or any tax credit claimed to be set off in accordance with the provision of Section 115JAA or 115JD, the SSC shall be liable to pay such tax together with interest payable under any provisions of this Act for any delay in furnishing the return or any default or delay in payment of advance tax before furnishing the return, and the return shall be accompanied by proof of payment of such tax and interest. So as the name suggests, self-assessment, this is the assessment which is being done by the SSC himself. SSC will determine what is the tax payable by him, and he will add the interest or penalty, whatever. He will deduct the amount of tax which he might already paid. He will deduct TDS, TCS or any credit which is entitled, and he would arrive at the next tax payable by him. And before furnishing the return, he will have to pay this tax, and the proof of such payment will have to be accompanied with the return. So what is self-assessment tax? All persons having taxable income, as we know, are required to file an income tax return each year. Before filing the return of income, SA is supposed to find out whether he is liable to pay any tax. SSC himself will determine the income tax payable while filing the return of income, and while filing a tax return, the SSC computes the income earned and paid tax as per the return filed by him or her. So this process of self-calculation of income and payment of tax is called self-assessment. So this is very simple thing. Here, our role as tax practitioner or tax consultants come, where we have to determine the tax which our client would be required to make a payment, and before filing his return, we have to ensure that such tax is paid. Next is summary assessment, which is under section 143(1). So first, let us read out what this section stipulates. Section 143(1) stipulates that where a return has been made under section 139 or in response to a notice under subsection 1 of section 142, return shall be processed, namely, the total income or loss shall be computed after making the following adjustments. Namely, now the adjustments which has been produced in the green color are very relevant, because here the assessing officer can make only these adjustments. He cannot make any adjustments other than what has been stipulated under section 143(1)(a). So what are those adjustments? One is any arithmetical error in the return. Second, an incorrect claim, if such incorrect claim is apparent from any information in the return. Third is disallowance of loss claimed, if return of the previous year for which set-off of loss is claimed was furnished beyond the due date specified under section 139(1). Disallowance of expenditure or increase in income indicated in the audit report but not taken into account in computing the total income in the return. And disallowance of reduction claimed under Section 10AA or under any provisions of Chapter 6A under the heading C, deduction in respect of certain income, if the return is furnished beyond the due date specified under Section 139(1). So the assessing officers, while making the summary assessment, is entitled to make only these adjustments. Now this is 143(1)(a). Now let's see what is 143(1)(b). There is also a provision provided that no such adjustment shall be made unless an intimation is given to the SSC of such adjustments either in writing or electronic mode. Provided further that the response received from the SSC, if any, shall be considered before making any adjustment, and in a case where no response is received within 13 days of the issue of such intimation, such adjustment shall be made. So it says that he is entitled to make these adjustments, but before making these adjustments, he will have to give intimation to the SSC that is trying to make these adjustments, and he will have to wait for a period of 30 days for the response from the SSC. B, C, D, and E speaks about how the tax would be computed, how the total tax would be computed, how the tax payable by the SSC would be arrived at. So B, C, D, E are general provisions which I'm skipping. So the main concern is summary assessment is a very preliminary assessment, and this is referred to as a summary assessment because SSC is not being called for. Without calling the SSC, this assessment is being done. Like this is like preliminary checking of the return of income, and at this stage no detailed scrutiny of the return of income is carried out. So whatever is appearing on the face of the return is accepted except the changes which we just saw in under section 143(1)(a). That is an arithmetical error. If there is an arithmetical error which is very apparent, the assessing officer can make the corrections. If there is an incorrect claim which is very apparent, he can make the correction, the adjustments. If in the previous year the return was not filed and there is a disallowance of loss claimed, then he can disallow such loss. Similarly, he can disallow the expenditure. And if the return is not furnished before the due date, then he can disallow the deductions under Chapter 6A under the heading C. So except these adjustments, no further adjustments are allowed. And after making these adjustments, the assessing officer would proceed to make the summary assessment. So what is the procedure? After correcting arithmetical error or incorrect claim, the tax and interest shall be computed on the basis of the adjusted income. So any sum payable by or refund due to the taxpayer shall be intimated to him. So there would be certain change because of the adjustments, either in the tax payment or in the refund. So that would be intimated to the SSC. An intimation shall be prepared and sent to the taxpayer specifying the sum determined to be payable by or the amount of refund due to the taxpayer. It might possible that due to these adjustments, refund may get decreased or it may result in the additional tax liability. So this intimation will be given to the SSC. An intimation shall also be sent to the taxpayer in a case where the loss declared in the return of income by the taxpayer is adjusted, but no tax or interest is payable or no refund is due to him. So it might happen that because of such adjustment, see, there is already a loss and there is a change in the loss, but that does not result into any additional tax liability, or neither it results into any change in the refund. So in spite of that, he will intimation will be required to be given. Okay, yes, there is a change in the loss which was declared in the return of income, and the acknowledgement of the return of income shall be deemed to be the intimation in a case where no sum is payable or refunded to the SSE, or where no adjustment is made to the return income. So this is a very simple exercise about the 143.1. The time limit is within 9 months from the end of the financial year in which the return of income is filed. So this is 9 months from the end of the financial year in which the return of income is filed. So for suppose for financial year say 21-22, the return would be filed in the financial year 22-23. So 9 months from the end of the financial year. So 9 months from March 23, that is December 23, would be the time limit. So now let's understand scrutiny assessment, which is very crucial. And as a tax practitioner, tax consultant, this is where our key role comes to play. Section 143.3 says that on the day specified in the notice issued under subsection 2, or as soon afterwards as may be, after hearing such evidence as the SSC may produce, and such other evidence as the assessing officer may require on specified points, and after taking into account all relevant material which he has gathered, the assessing officer shall, by an order in writing, make an assessment of the total income or loss of the assessee and determine the sum payable by him or refund of any amount due to him on the basis of such assessment. So as the name suggests, scrutiny assessment, here the scrutiny of the income tax return filed by the SSE takes place. This is a detailed assessment. And at this stage, it is this stage that detailed scrutiny of the return of income is carried out to confirm the correctness and genuineness of various claims or deductions or income itself, which is being reflected in the return of income. The main objective of scrutiny assessment is to confirm that taxpayer has not understated the income or has not computed excessive loss or has not underpaid the tax in any manner. So to how the assessing would be, how the assessing officer will be able to confirm the same. So to confirm, assessing officer carries out detailed scrutiny of the return of income and will satisfy himself regarding various claims, deductions made by the taxpayer in the return of income. And for carrying out scrutiny assessment, it is very imperative for the assessing officer that is required to issue notice to the SSC in accordance with the provisions of section 143.2. So we'll study these sections in little bit detail. So what happens? So after once the income tax return is filed, a tax officer would be assigned by the income tax department based on certain criteria to undertake an examination. Then suppose the return is selected for the scrutiny. The assessment officer would issue a notice under section 143.2 informing that your case has been selected for the scrutiny assessment. And the tax officer would request certain information, documents, and books of accounts. So as a practitioner, we know that we get a long list of requirements from the department. Some are very standardized requirement, some are specific to the case, and very elaborate list of requirements would throw upon us by the assessing officer for the scrutiny purpose. So we are required to produce those information documents. So after scrutiny of the information and documents produced by the SSE, The income tax officer would complete an assessment and compute the amount of income and tax payable by the taxpayer. Now, definitely there would be mismatch. So if there is any mismatch in the amount of taxable income or taxes to be paid, the taxpayer could agree with the order passed by the officer and pay the demand and accept any amount of refund or loss as determined by tax officer, or can go for the appeal. The taxpayer can also apply if feels that there is an rectification is required, which is very clerical error is appearing. So he can also apply for rectification of income tax return under section 154 if any clerical error persists, or else the SAC can also make a revision application to the CIT under section 263 or section 264. Finally, if the order passed in a scrutiny assessment is not acceptable, the taxpayer can move to CIT appeals, and then the whole gamble of process of legal battle would commence with appeal to CIT, then ITAT, then High Court, and then Supreme Court, as the case may be. So as a tax practitioner consultant, our major role comes when our client is selected for the scrutiny assessment. So as we said, before carrying out this, he is required to issue notice under section 142(1). So notice under section 121 is issued only when return of income is already filed or the time limit for filing the return is over. So this notice is issued for either asking the SSC to file the return or to call for details where ROI has been filed. However, no such information can be called for relating to a period more than 3 years prior to the previous year. So this is a time limit. And if the AO desires details of assets and liabilities not included in the accounts, he shall do so only after obtaining the previous approval of the Joint Commissioner. So now notice under section 142(2)(a). So under the provision of section 142(a), the assessing officer can direct the SSC to get his accounts audited. So if he feels that accounts does not reflect the true and fair view, and he feels that there is some jugglery in the accounts, he can ask for a special audit. So a special audit would be directed by the assessing officer under section 142(2)(a), having regard to the nature and complexity of the accounts and the interest of revenue. The accounts of the SSC can got audited by an accountant nominated by CIT or the CCIT, but only after for which the previous approval of the CIT or CCIT is required. And it is incumbent upon the assessing officer to give the SSC a reasonable opportunity for being heard before such a reference is made. So before the special audit is directed, the assessing officer would be required to give the SSC a reasonable opportunity to submit his response. And once the direction is issued, the audit is required to be completed within 180 days. So to trigger scrutiny assessment, the first trigger is notice under section 143(2). So once notice under section 132 is issued, it opens the door for a scrutiny assessment. So the notice would be issued only when return of income has been filed, and it permits the assessing officer to make an assessment order after scrutinizing the details filed, evidence is produced by the SSC, and after taking into account all relevant material that the AO has gathered. So what is the procedure for scrutiny assessment? If the assessing officer considers necessary or expedient to ensure that the taxpayer has not understated the income or has not computed excessive loss or has not underpaid the tax in any manner, then he will serve on the taxpayer a notice requiring him to attend his office or to produce or cause to be produced any evidence on which the taxpayer may rely in support of the return. So in the income tax return, we have specified certain incomes, we have claimed certain deductions, and the assessing officer feels that this may not be the genuine. So he need to satisfy himself. So to satisfy himself about whatever income is mentioned in the return and whatever the deductions or claims have been mentioned, he will ask the whatever the informations which he feels is necessary for him. So as we said, for asking such information, he would issue notice under section 143(2), and in response to such notice, either the taxpayer can himself appear or in spite of him, his representative, that is mostly we professionals, appear before the assessing officer and we place our supporting documents, evidences, our reasonings, our arguments on various matters to satisfy the assessing officer that whatever has been mentioned or whatever has been claimed in the income tax return is fair and genuine. So what assessing officer will do? After hearing or verifying such evidence and taking into account such particulars as the taxpayer may produce and such other evidence as the assessing officer may require on specified points, and after taking into account all relevant material which he has gathered, the assessing officer shall by an order in writing make an assessment of the total income or loss of the taxpayer and determine the same payable by him or refund of any amount due to him on the basis of such assessment. So once the scrutiny is completed, it's possible that the assessing officer might have gathered certain information from his internal sources, and after whatever explanations or documents have been placed by us, so after examining all, he will make his assessment and would arrive at the income. So what is the time limit for assessment year 21-22? It is 9 months from the end of the assessment. And if the reference is made to TPO, the period available will extend by 12 months. If return has been furnished under section 139(8)(a), the order of assessment shall be passed within 9 months from the end of the financial year in which such return was furnished. So next comes based judgment assessment. So as the name suggests, based judgment assessment is the judgment which an assessing officer will make to assess the return. So let's read what the section has to say. Section 144(1), if any person fails to make the return required under subsection 1 of section 139 and has not made a return or a revised return under subsection 4 or subsection 5 or an updated return under subsection 8A or fails to comply with all the terms of a notice issued under subsection 1 of section 142 or fails to comply with the directions issued under subsection 2A, 142(2)(a), or having made a return fails to comply with notice issued under section 143(2), the assessing officer after taking into account all relevant material which the assessing officer has gathered, shall, after giving the assessee an opportunity of being heard, make the assessment of the total income or loss to the best of his judgment and determine the sum payable by the assessee on the basis of such assessment, provided that such opportunity shall be given by the assessing officer by serving a notice calling upon the assessee to show cause on a date and time to specified in the notice why the assessment should not be completed to the best of his judgment. Provided further that it should not be necessary to give such an opportunity in case where notice under section 142(1) has been issued prior to making of the assessment under this section. So what is base judgment? Base judgment refers to the computation of income and tax payable based on the base judgment of the income tax officer. So whatever income tax officer feels deemed fit, he will make assessment accordingly. So base judgment assessments are performed when the assessee does not cooperate with the income tax officer's request for information, or does not file a tax return, or does not maintain necessary books of accounts. So the base judgment proceedings can be initiated when the taxpayer does not file return. So when the return has not been filed, the assessing officer does not have any choice but to make judgment himself. Okay, what could be the return of the taxpayer? The taxpayer does not comply with an income tax notice issued for filing an income tax return or conduct an audit of accounts. If the assessee says that no, he will not produce audited books of accounts, then the assessing officer would make his own judgment and would make the assessment accordingly. The taxpayer does not comply with the request for information and documents during scrutiny assessment. So when under the scrutiny assessment, the assessee fails to produce the information documents, so then what the assessing officer will do? He will make his own judgment and will pass. So at the time of scrutiny assessment, it is very important as a professional to see that the informations or documents or explanations sought by the assessing officer are submitted very accurately, very precisely, and in a very time-bound manner. Or the assessing officer is not satisfied with the information or documents presented by the assessing. So under these circumstances, which has been presented here in the green color, the assessing officer would proceed with the based judgment assessment. So if the conditions given above calling for base judgment is satisfied, the assessing officer will serve a notice on the taxpayer to show cause why the assessment should not be completed to the base of his judgment. If the assessing officer is not satisfied by the arguments of taxpayer and he has reason to believe that the case demands the base judgment, then he will proceed to carry out the assessment to the best of his knowledge. So we can say that this base judgment assessment is just like an ex parte judgment or one-sided judgment where the assessing officer will assess the income whatever he deems fit. So these are the basic main three criteria which we see: return not filed, or non-cooperation, or non-furnishing of informations, or incomplete books of accounts, or non-production of books of accounts. So these are the main reasons under which base judgment assessment would be carried out. The time limit is again 9 months from the end of the assessment in which income was first assessable. If reference is made to TPO, it extends to 12. If return has been furnished under section 139(8)(a), the order of assessment shall be passed within 9 months from the end of the financial year in which such return was furnished. Now we know one section, the section 139(8)(a), which was introduced from the Finance Act 2022, wherein the SSC was given an option to update the return. SSC has already filed the return, and he was given an opportunity by introduction of this section 139(8)(a) that he can update the return within 24 months from the end of the relevant assessment year. So once the updated return has been filed, the time limit would get extended, and he will get the 9 months from the end of the financial year in which such return is furnished. So just let's briefly understand what is the section 139(8)(a) and what it speaks about the updated return. So updated return can be filed only if the taxpayer has to disclose any additional income which was missed, omitted earlier, and pay the additional tax thereon. So means this reflects that updated return can be only upside. It cannot be downside. Like updated return cannot be filed to reduce the income or report loss or increase the loss. So updated return should always result into increase in the tax liability, and it should not result into reduction in the tax liability or increase in the refund. So the SSC can opt for updated return only if he feels that yes, there is some income which was missed out, and it's better to pay the tax, disclose the income and pay the tax to avoid the adverse consequences at a later stage. So an option of return can be opted only once for one assessment year. So once SSC has filed updated return, he cannot again go for updated return for the same assessment year. So this right is available only once per assessment year. Now what about the tax payment? So if the updated return is being filed within 12 months from the end of the assessment year, then SSC will have to pay additional income tax of 25% and interest thereon. So whatever is the tax liability, that would get increased by 25% plus interest. And if return is filed after 12 months, but before 24 months, that is 24 months is the upper limit. So then additional income tax of 50% and interest is payable. And while filing an updated return, the proof of payment of additional income tax and interest thereon shall have to be submitted. But this right to file updated return is not available in case of search and seizure or a case where any prosecution proceedings have already been initiated against the taxpayer. So in the case of search and seizure or where prosecution proceedings have been undertaken, the SEC cannot take shelter of section 139(8)(a) by filing the updated return. So now let's understand section 147, which speaks of income escaping assessment. The section reads that if any income chargeable to tax has escaped assessment for any assessment year, the assessing officer may, subject to the provisions of section 148 to 153, assess or reassess such income or recompute the loss or the depreciation allowance or any other allowance or reduction for such assessment year. For the purpose of assessment or reassessment or recomputation, the assessing officer may assess or reassess the income in respect of any issue which has escaped assessment, and such issue comes to his notice subsequently in the course of proceedings under this section, irrespective of the fact that the provisions of section 148A have been complied or not. So the Finance Act 2/2021 had substituted the existing sections 147, 148, 151 and also inserted a new section 148A, making a complete change in the assessment proceedings related to income escaping assessment and such related cases. So if any income has escaped assessment, the assessing officer, subject to the provisions of section 148 to 153, assess or reassess such income, and also any other income which has escaped assessment and which comes to his notice subsequently in the course of the proceedings, or recompute the loss or the depreciation allowance or any other allowance for such assessment year. So what is the procedure? See, once the assessment is done and if he finds that there is some income which has escaped, then the assessing officer will use the weapon of section 147 for assessing such income. So first he is required to issue notice. So the assessing officer shall serve on the assessee a notice under section 148 along with a copy of the order passed under clause D of section 148A, requiring him to furnish return of his income or the income of any other person in respect of which is assessable under this act. This notice shall be issued in the prescribed form and verified in the prescribed manner, setting forth such other particulars as may be prescribed, and the provisions of the Income Tax Act shall, as far as apply, accordingly if such return were a return required to be furnished under section 139. So once the notice has been issued, this return would be treated as if it was a return filed under section 139. So under which circumstances notice can be issued? So notice is required to be issued only when information with the assessing officer suggests that the income chargeable to tax has escaped assessment. So firstly, he will have to satisfy himself, okay, yes, he has got certain information which proves that there was certain income which was chargeable to tax, but that has not been brought to the tax net. So prior approval of specified authority is also required to be obtained before issuing such notice. However, no such prior approval is required if the assessing officer has passed an order under section 148A with prior approval of the specified authority stating that income is escaping assessment. The next stage would be, so when it shall be deemed that income has escaped assessment. So firstly, there would be two scenarios. One scenario would be in the case of search, survey or requisition, and another scenario where there is no search, survey or requisition. So once it falls under these categories that yes, the income has escaped assessment, then only it would be possible to trigger section 147. So to trigger section 147, first it will have to be determined whether income has escaped assessment or not. So when it will be deemed that income has escaped assessment, so there will be two scenarios. If there is no search, survey or acquisition, then first point, the information suggesting that the income chargeable to tax has escaped assessment means any information flagged in the course of the in the case of the SSE for the relevant assessment year as per the risk management strategy formulated by the CBDT from time to time. Any audit objection to the effect that assessment in the case of the SSE for the relevant assessment year has not been made in accordance with the provisions of the Income Tax Act. So once the assessment is done and we know departmental audit takes place. So when an audit objection is raised, when the objection is raised by the audit team and they have find out certain fault in the assessment, then notice would be issued under section 147. Any information received under an agreement referred to in section 90 or 90A. Now we know section 90 and 90A refers to agreement with foreign countries or a double taxation relief. So whenever, because of such agreement with foreign countries or double taxation relief, we feel that no, there is an income which was subject to tax in India, but which has escaped the tax in India, and any information made available to the assessing officer under 135A, which is like faceless collection of information by the department, and any information which require action in consequence of the order of a tribunal or a court. So after the assessment is done, there is an order of a tribunal or a court which changes the position and which results into certain income which was not earlier taxed, and it because of such an order of a tribunal or a court, such income is brought to the tax, then it will be deemed that income has escaped assessment. Now we saw these cases where there was no search, survey or acquisition. So what happens in case of search, survey or acquisition? So in the case of search, survey or acquisition, income would be deemed that it has escaped assessment when such survey or acquisition case is initiated after April 21. It shall be deemed that assessing officer has information which suggests that income chargeable to tax has escaped assessment in the case of the SSE for 3 assessment years immediately preceding the assessment year relevant to the previous year, where search is initiated under section 132 or books of accounts, other documents or any assets are requisition under section 132A. Second, survey is conducted under section 133A. Third, assessing officer is satisfied with the approval of CIT or principal CIT that any money, bullion, jewelry or other valuable article or thing seized or requisition in case of any other person on or after April 21 belongs to the SSE, or the assessing officer is satisfied that with the prior approval of PCIT or CIT that any books of accounts or documents seized or requisition in case of any other person on or after April 21 pertains to or pertain to or any information contained therein relate to the assessing. So these are very important. What happens when the search or survey takes place? Suppose search or survey has taken place in the case of SSCA. So while the premises of SSCA is being searched, they found certain documents or certain assets which they feel that it's not belonging to A, but it is belonging to B. So in such case also, they get the right to trigger section 147 in case of SSCB. So in case of search, survey, requisition cases, if it falls under this criteria, then it will be deemed that income has escaped assessment and assessment under section 147 would be carried out. So what is the procedure? So before issuing notice, the assessing official shall be required to follow the procedure as laid down in section 148A. So first, he has to conduct the inquiry. The assessing officer shall conduct an inquiry with the prior approval of specified authority concerning the information which suggests that income chargeable to tax has escaped assessment. Granting an opportunity of being heard, the assessing officer shall provide an opportunity of being heard to the assessee by serving upon him a notice to show cause within such time as may be specified, but not less than 7 days, not exceeding 30 days, as may be extended based on the application as to why such notice under section 148 should not be issued based on the information which suggests that income chargeable to tax has escaped assessment. In his case, for the relevant assessment year and results of an inquiry conducted. So first, he will conduct the inquiry. For conducting the inquiry, he will be required to issue the notice. The notice will specify a period of minimum 7 days, maximum 30 days. And the assessing office, the assessee would be required to respond to such notice. So first, once notice is issued, the assessee has replied to the notice. So the assessing officer will be required to consider the reply furnished to in response to such show cause notice, and then he will pass an order. The assessing officer then decides based on material available on record, including reply of the assessee, whether or not it is a fit case to issue a notice under section 148 or by passing an order with the approval of specified authority within 1 month from the end of the month in which the reply of the assessee is received by him, or where no such reply is furnished within 1 month from the end of the month in which time or extended time allowed to furnish the reply expires. So procedure is like, it's not like say, section, the proceeding in section 147 would be carried out once he feels that, once the assessing officer feels that income has escaped assessment. Firstly, he have to conduct the inquiry, he will have to issue the notice. Then whatever the reply has been furnished, he will have to consider it, he will have to respond to such reply, and then after taking the approval, he can proceed with section 147 assessment. So the upper time limit is 3 years. So if 3 years have elapsed from the end of the relevant assessment year, then section 147, the case will not fall under section 147. So the upper time limit is general provision says that no notice can be issued if 3 years have elapsed from the end of the relevant assessment year. And however, where the assessing officer has in his possession books of accounts or other documents or evidence which reveals that income chargeable to tax represented in the form of an asset or expenditure in respect of a transaction or entry or entries in the books of accounts which has escaped assessment or is likely is 50 lakhs or more, then notice can be issued up to the period of 10 years from the end of the relevant assessment year. So general provision is the upper limit is 3 years from the end of the relevant assessment year. However, the period of 3 years will get extended to 10 years when the assessing officer has got certain document which proves that income chargeable has escaped assessment, either it's a form of asset or an expenditure which was not booked, any expenditure on transaction, event or occasion, or entries in the books of accounts where the amount involved is 50 lakhs or more. So now it may happen that notice can be issued if income exceeding assessment is spread over more than 1 year. Now it sometimes happened that income might have been spread to more than 1 financial year. So a notice under section 138 can be issued after 3 years but before 10 years if escaped income of rupees 50 lakhs or more is represented in the form of an asset, expenditure or entry. The Finance Act 2022 had introduced subsection 1A to section 149 to provide that if such escaped income represented in the form of asset or expenditure in respect of a transaction, event or occasion is spread over more than 1 year and the total escaped income in all these years is rupees 50 lakhs or more, the AO gets jurisdiction to issue notice under section 148 for all those years. So this is very important change which was made. Like if it is felt that the escaped income is in the form of an asset or expenditure entry. Suppose the SEC has made a lavish marriage, okay, and certain evidence comes to notice of the assessing officer that huge amount was spent on such marriage, and the source of such expenses is not, it does not appear to be genuine, or the income tax return filed by the SSC does not reflect the scope of incurring such heavy expenditure, then the assessing officer gets right to reopen, to tax the under section 147, and the period would get extended up to 10 years. Now, sometimes it might happen that expenditure might have been incurred in two financial years, or certain expenditure have been incurred in March and certain expenditure have been incurred in April. So it would spread over two financial years. So the Finance Act 2022 had introduced section 149(1)(a) to cover all such type of expenditure where the expenditure is spread over more than one financial year. So in such cases also, the assessing officer will get jurisdiction to issue notice for all those years. If the expenditure is spread over two financial years, then AO will get the jurisdiction to open the assessment and for both the assessment years. So sometimes it happens that protective assessment, it's not certain. The assessing officer may not be able to find out who is the real assessee. It's not ascertained for him to identify that who is liable to pay tax. So in such cases where it is not ascertainable as to who is liable to pay income tax, the protective assessment is also called alternate assessment can be made. So it's like a paper assessment, and it will be made till the real taxable person is identified. So protective assessment is permissible, but protective order for recovery is not permissible, because before recovery they need to identify who is the real taxable persons, and only when the real taxable person is identified, then only recovery mechanism can be initiated. Now let's see important provisions about the search assessment in the case of search or requisition, which is section 153A. Section 153A reads, the assessing officer shall A. issue notice to such person requiring him to furnish within such period as may be specified in the notice the return of income in respect of each assessment year falling within 6 assessment years referred to in clause B in the prescribed form and verified in the prescribed manner, and setting forth out such particulars as may be prescribed, and the provisions of this act so far as may be apply accordingly as if such return were a return required to be furnished under section 139. B. Assess or reassess the total income of 6 assessment years immediately preceding the assessment year relevant to the previous year in which such search is conducted or acquisition is made. So in case of search, section 153A gives the right to the income tax department, to the assessing officer, to reopen the assessment for 6 assessment years immediately preceding the assessment year in which such search was conducted. So this is very wider power for the assessing officer when search or acquisition takes place. Now let's try to understand the different scenario as far as search operations are concerned. Scenario 1 is when the search takes place, the return of income was not filed by the assessee. So when the return of income is not filed, the entire income will be regarded as the undisclosed income. Now we know there is a different treatment to our income which is mentioned in the return and which is undisclosed income. So when at the time of search return of income was not filed, then the entire income which would be treated as the undisclosed income and would be treated accordingly. Now, second scenario can be return of income was just filed by the SSE. Return is yet to be processed under section 143(1) and time limit for issue of notice under section 143(2) is not expired. So under this scenario, since return file is even pending to be processed, the return would be treated as pending before the assessing officer. Consequently, the assessing officer would have authority or jurisdiction to assess the entire income similar to jurisdiction in regular assessment under section 143(3). Another scenario could be return of income was filed by the SSE, return was processed, and intimation was also issued under section 143(1), but time limit for issuance of notice under 132 is not expired. So under this scenario, since intimation is not akin to the assessment and time limit for notice under section 143(2) has not expired, even though return has been processed, it will be a case where return has not attained finality. So consequently, assessing officer would have authority or jurisdiction to assess the entire income similar to jurisdiction in regular assessment under section 143(3). Now another scenario could be where return of income filed by the SSE, intimation whether passed or not, and time limit for issuance of notice under section 142 has expired. So once the time limit for issuance of notice under 2 has expired, return of income of the SSE shall be treated as having been accepted, and it will be treated that as if return of income has attained finality. So AO will lose the jurisdiction to verify the return of income, and since no assessment would be pending, there would be no abatement of any proceedings. Accordingly, the scope of assessment in section 143A would be restricted to incriminating material found during the course of the search only. So here the scope of the assessing officer would get limited to only tax those income which has been found during the search and seizure. So he will able to use only those incriminating material found during the course of search. Another scenario could be notice under section 142 is issued and assessment is pending under section 143(3). So here pending regular assessment proceedings would abate and it would merge into proceeding under section 153A. Accordingly, the scope of assessment under section 143A would cover the pending return filed as well and would not be restricted to only to incriminating material found during the search. Another scenario could be assessment under section 143(3) is completed. So since regular assessment proceedings have been completed and not pending, there would be no abatement of proceedings. So here also, once again, as assessing officer loses the jurisdiction to review the completed assessment. Accordingly, the scope of assessment under section 143A would be restricted only to incriminating material found during the course of search. Next scenario could be proceeding under section 147 pending, where assessment originally completed under section 130, originally completed under 143, or no assessment earlier completed under section 143(3). So when pending assessment or reassessment proceeding under section 147 would abate and it would get merged into proceeding under section 143A. So accordingly, the power of the assessing officer in both the cases shall extend to assess income that could validly be assessed in the pending proceedings under section 147 and income to be assessed based on the incriminating material found during the search. So here in this scenario, the assessing officer would be able to tax as on the both the basis. Now, another important sections in the case of search is section 153C. Section 153 when the search takes place and the income would be taxed of the tax of the SSC on whose premises the search has taken place. Now, during the search, it might happen that certain documents are found which proves that income of some other person may become subject to tax. So, let's read section 153C. Notwithstanding anything contained in section 139 or section 147, section 149 or section 149, where the SSC is satisfied that any money, bullion, jewelry, or other valuable article or thing, says or requisition belongs to, or any books of accounts or documents, says or requisition pertains or pertain to, or any information contained therein relate to a person other than the person referred to in section 153A, then the books of accounts or documents or assets seized or requisition shall be handed over to the assessing officer having jurisdiction over such other person, and that assessing officer shall proceed against each such other person and issue notice and assess or reassess the income of the other person in accordance with the provision of section 153A. If that assessing officer is satisfied that books of accounts or documents or assets, sales or acquisition have a bearing on the determination of the total income of such other person for 6 assessment years immediately preceding the assessment year relevant to the previous year in which search is conducted or requisition is made, and for the relevant assessment year or years referred to in subsection 1 of section 153A. So section 153C gives the right to the assessing officer to tax the income of any other person for a period of, just like the provision of section 153A, here the assessment of six assessment years could be made of any other person. Suppose search is conducted on the premises of A and certain books of accounts or documents or any other asset is found of B, then the same assessment under section 153A for 6 assessment years could be conducted on SSC B also. So it would happen that the assessing officer of SSC A and SSC B would be different. Then what would be done? The assessing officer of SSC A would pass on all those information documents to assessing officer of SSC B, and then that assessing officer would carry out the proceedings under SSC B as if it was a proceeding under section 153A. So the Finance Act 2015, which this enables the AO of the search person to initiate proceedings under section 153C even if books of accounts or documents do not belong to other person. The requirement is the documents relate to or pertains to such other persons. So by the Finance Act 2015 had widened the scope of 153C, wherein the document, whether it relates to or pertains to such other persons, were also brought into the tax network. So any money, bullion, jewelry, or other valuable article or thing, sales or acquisition belongs to, or any books of accounts or documents, sales or acquisition pertains to or pertain to any information contained therein relates to. So normally the documents are handed over by the AO of such person to the AO of other persons only after he realizes that such document or assets belong to other person. So this is the effect of block period being different in case of search person and the other persons. Now what happens that in the case of A, the search has taken place in say financial year 21-22. So before handing over the document to the assessing officer of SSC B, the assessing officer would take certain time. it might not happen that he might not in a position to hand over all the documents to assessing officer B immediately. And suppose the search has conducted in the month of March, and he hands over the documents in the month of April. So this will have the effect of change of the financial year. So as the financial would get changed, the scope of assessment for SSCB would also get changed. So it might happen that block period for SSCA could be different and the block period for SSCB could be different. I will just take a break of 2 minutes, please. Hello. Hello.
Hello.
Yes, sir.
Yeah, I will just take a break of 2 minutes. Just give me 2 minutes.
Yeah, no problem.
Yeah.
Right off and please.
Yes, we are back now. So for any assessment, the main principle is principle of natural justice. This is a very basic principle of law that says that no man shall be condemned unheard. So whenever any decision is required against any SSE, the principle of natural justice demands that he should be given an opportunity to explain his case. He should be given an opportunity to justify or to give a proper reasonings to satisfy his stand. So if AO has granted a hearing and for some reason the SSE is unable to keep that appointment, it is in the latter's interest to seek an adjournment after giving these reasons. So many times as a tax practitioner, tax consultant, it happens that the assessing officer has scheduled a hearing on a particular day, and it might be possible that it's not convenient for some genuine reason to appear on that day. So it would be in our interest, it would be in the interest of our client to seek an adjournment giving the genuine reasons. So if he just remains silent, so it might happen that he may proceed ex parte. So the principle of natural justice should always keep in mind, because if we remain, if the notice is remain unattended, then as we say earlier, as we studied earlier, the assessing officer has got the power to pass assessment ex parte or what we call as base judgment assessment. Further, section 144 states that where any person has failed to file the
Sir.
return of income,
Voice is echo, getting echo.
there is a echo.
Yeah.
Earlier it was going very smoothly. Hello.
Hello.
Earlier it was going smoothly. Echo has started after the break, or it was coming previous only also? Hello. Hello.
Hello, yes, sir.
Now voice is clear, or still you feel echo?
Oh, okay, you can continue, sir.
No. If echo is there, then
No,
whether-
echo is not there.
echo is not. No, somebody said no. There is an echo.
No.
Okay.
Okay, continue.
Section 144 states that where any person has failed to file the return of income or failed to comply with the terms of notice issued under section 142(1) or 142(2), then AO shall make an assessment to the best of his judgment, taking into account the relevant materials available. So the only defense that is available to the SSC is to establish that there was a sufficient ground for failure to attend before the assessing officer. So these are the basic principles of natural justice which would prevail in all assessment. So it would be our duty to satisfy the assessing officer that there was a genuine reason, there was a genuine failure with some genuine reason that we could not respond to him, or if the response was either we could not respond or we could submit a late response. So principle of natural justice should always be kept in mind. So let's see what are the major issues in assessment. So whenever we fail the scrutiny, there are certain major issues which we as a tax practitioner or tax consultant face. So these are the issues under which most of the time we feel that additions takes place. So we should always be a little bit particular or cautious while dealing with such issues. One such issue is section 68, which is which says very alarming section where unexplained cash credit becomes taxable. So whenever any justification is sought under section 68, we should be very particular. Our reply should be very specific, clear, and to the satisfaction of the assessing officer. Because if our reply is not to the point, or we fail to establish the genuineness, or we fail to produce the necessary evidence, then it may lead to the additions under section 68. Another such is treatment of capital expenditure versus revenue expenditure. Sometimes we treat certain expenditure as revenue expenditure, and the assessing officer may take a stand that is not a revenue expenditure. So there also we need to satisfy the assessing officer about our treatment. Then same thing happens about section 56 to under gifts. Then payments specified under section 43B. We understand that the certain sums, if it is not paid, before the due date of filing of return of income, then it's not allowable. Then it is disallowed. So we have to be very cautious. We have to educate our clients also that before the return is filed, if there are any pending payments, such payments are made. These payments are any sum payable by way of tax, duty, cess or fee, bonus or commission to employees, interest on loan or borrowings from any public financial institution, interest on any loans and advances from a scheduled bank, leave encashment, contribution to any provident fund, superannuation fund, gratuity fund, etc. So we have to ensure that additions does not take place under section 43B. Another important criteria is maintenance of gross profit and net profit ratios. This is particularly very relevant in case of trading concerns because as far as trading units are concerned, there could not be a large amount of variations in the GP ratios and net profit ratios. Sometimes for manifold concerns, it might happen that the ratios may change or there might be certain variations over the years. But as far as the trading concerns are concerned, if there are large variations over the years in GP ratios and net profit ratios, then it might also lead into the addition. We need to have proper justification for change in the GP ratios. So whenever we submit the return, we need to calculate the GP ratios and we need to also study what was the trend prevailing in the previous years. And if there is any major deviations, then we should seek the explanations from our client before submitting the return. Then another issue is payment to related parties. As we know under section 48(2)(b), any payment made by an SSC to a related person is disallowed if it is excess or unreasonable. So before filing the return, we need to scrutinize all such payments which are made to the related parties. And we need to check whether it falls under the criteria of reasonableness or not. We may compare such payments with payments made to other non-related parties, or if there are no such payments which is made to non-related parties, then what is the rates prevailing in the market? And we need to satisfy ourselves that all such payments are very reasonable and there is no amount of any excessiveness in such payments. Then disallowance of business expenditure on account of non-deduction of tax on payment to resident pays. Now certain payments are disallowed if there is a failure to deduct the tax. So we need to scrutinize all such payments where and need to check whether that payment is subject to TDS or not. And if those payments are subject to TDS, then we need to ensure that TDS payments are made. TDS has been deducted and it is paid before the due date. So otherwise, it might result into disallowance of such expenditure. So how to handle the assessment? First and foremost, we must know the facts of the case. And we must try to understand the nature of business of our client. Without understanding the nature of the business, it's very difficult, it would become very difficult to justify various questionnaire during the time of scrutiny assessment. And we should have clear knowledge of the facts. So whenever we handle the scrutiny assessment, first we need to understand the questions very thoroughly, try to find out the correct facts, the nature of the business of the client, we need to study it, and then we need to respond it. And whatever we present to the assessing officer should be very clear. Our reply should not be very unambiguous. It should not be ambiguous. If it is unambiguous, then the assessing officer may not be able to draw a clear picture, and that may lead to the addition. Another important factor in handling the assessment is punctuality of our presentation and punctuality of our appearance. Whenever the notice is issued to appear on a particular day, if there is a genuine reason, we may seek adjournment. But seeking adjournment should not become a matter of habit. The assessing officer should also have the confidence in us that if we are seeking the adjournment, then there must be genuine reason. And he should not treat us as habitual adjournment seekers. So this will have a positive impact while dealing with the assessing officers. Then prompt response would also help. Whenever we submit the prompt response, it always creates a positive energy or positive impact on the assessing officer. Next important thing is to study the relevant judgments. So whenever the case is complicated or whenever the query is raised, like let's see first the example of classification of capital expenditure versus revenue expenditure, then we need try to study the relevant judgments of the past. In our presentation or in our reply, we should try to incorporate the relevant judgment which are in our favor, and we need to justify our submissions based on such judgments. This would always help us to avoid unnecessary additions. So it's very important that now technology has has opened up a lot of scope that, and we are able to find out the relevant judgments very easily. So it's always better that we study those relevant judgments and then we make our presentation. Another important is study past assessment order. So it might happen that an issue which we are facing in particular in the current assessment year might have appeared in the past assessment year also. So we need to study what was the treatment given by the assessing officer in those past assessments. So this would also help us to draw a clear line and justify our stand. Modesty and humbleness is always required for any professional dealing. Another thing is we should always try to seek acknowledgement. Whatever way submissions we make, it's very imperative that we seek the acknowledgement and we keep it on our record. And wherever books of accounts are required, we should produce the books of accounts very clearly, and this would enhance the confidence of the assessing officer. So handling the assessment is also an art also. On one hand, we should have the technical knowledge, and apart from the technical knowledge, we should have the art to deal with the assessing officer or to deal with the department. So it's a combination of knowledge and art which would make us a successful tax consultant or tax practitioner. So now let's see certain important judgments. So this is a case of search where it was held that it does not matter whether or not incriminating material has been found during the course of search. So once the warrant of authorization or requisition is issued and search is conducted and the panchrama is drawn, all the relevant 6 assessment years will get opened irrespective of any incrementing material found or not, in respect of any particular assessment year falling with the assessment year. So it might happen that a search is conducted. However, during the search, they don't find any such incoming material. So this will not stop the department from reopening the block assessment. So irrespective of whether during the search, whether any incoming material is found or not, the block assessment will take place. So only the assessment pending before the assessing officer for completion shall abate for fresh assessment. As regards the completed assessment, the issues decided in the completed assessment cannot be reconsidered and re-educated unless there is some fresh material found during the course of search in relation to such points. So when the assessment is already completed, the issue which was already decided in the completed assessment, it cannot be reconsidered or re-educated unless there is some definite material which leads to the conclusion that yes, the earlier reasoning was wrong. So unless a direct nexus between the incrementing material found during the course of search and the earlier assessment, completed assessment, it's not open to rework out or reconsider or re-adjudicated those assessments. So here in the case of Freedom Foundry, the assessment was completed under section 143.3. The assessment was reopened after 4 years on the ground that SSC has claimed melting loss in excess of certain percentage. So the SSC objected reopening, but however it was rejected. The SSC challenged the order by the writ petition. The court allowed the petition and held that there is no allegation in the reason of failure on the part of SSC to state fully and truly all material facts necessary for assessment, and the assessment having made after verification of records, reopening after 4 years was not sustainable. So for any reopening, it's important that it is important to establish that yes, something was not presented correctly or something incorrect was presented. Now here was the case where the melting loss of certain percentage was already mentioned in the return, or it was already appearing in the books of accounts. So the assessing officer, there was nothing new which the assessing officer has found out. So considering such argument, the reopening was not allowed. So it's important that some new facts or material should be present to enable the assessing officer to reopen the assessment. So without any new facts or without any new material in his possession, the assessing officer cannot reopen the assessment. Here the petitioner had been returning his income from playing oil tankers for several years. The claim towards driver's expense was within the knowledge of the assessing officer at the stage of original assessment. The finding of the successor in office ignored the findings of the predecessor on the issue and disallowed the expenses in entirety. So here what happens that earlier the assessment was being carried out by assessing officer A. Now subsequent to the assessing officer got changed and it was replaced by assessing officer B. Now assessing officer B had got a different view and he didn't accept the view which was taken by the earlier assessing officer. So, and changing his stand, he made certain additions. So here it was held that it's a change of opinion. The facts has remained changed. Merely the assessing officer has changed, and change of opinion of an officer A to change of officer B cannot be considered as new facts or new material, and the reassessment was not allowed. So it's very important that for reopening of the assessment, there has to be certain new facts or certain new material. And if there is no change in the facts or there is no change in the substance, then reopening cannot be allowed. So here, notice under section 142 was not issued. So it is mandatorily not mere. So issuance of notice under section 143 is mandatorily. It's not merely procedural for the assessing officer to issue notice under section 143(2). So if the notice is not served within the prescribed period, then the assessment order would be treated as invalid. So it is very mandatory for the assessing officer to issue notice under section 143(2). Without that, he cannot proceed for the assessment. And even if the notice is not served within the prescribed period, the assessment order would be deemed to be invalid. In case of Motorola, if a person has not furnished his return of income within the due date given in section 139(1), the AO can serve a notice under section 142(1) at any time after the expiry of time limit given under section 139(1). So this is very clear that notice can be issued. So with this, I am through with my presentation. If anybody has got anything, any queries, then the floor is open.
Toxi sir, whether we will have a separate session on refund?
Haji?
Whether we will have a separate session on refund?
Yeah. I will cover it that when we take the faceless assessment.
Okay, you will cover it
Yeah.
at that time. Okay,
Yeah.
okay. Anyone has any query? So there is a question in the chat box.
I will just see that.
Yeah.
What is the query? I'm not able to find out.
Now scrutiny assessment are also
Yeah, that is
conducted
the opinion. Yeah, there is
electronically.
not a query. There is now
That is
now
not a
the
query.
question of
Okay.
faceless assessment are already started. So now everything, as we said, everything is now electronically. Everything is now going to be faceless.
Yeah.
So yeah, any
Okay.
special points you would like to say in handling such? Now you are talking of faceless assessment. We have got a separate topic, separate session on faceless assessment. So we would cover all such points pertaining to faceless assessment during our that session.
If you have got any query, please unmute yourself and you can ask your query. Once CMA Dilip has mentioned, any special point you would like to say in handling such assessment?
Yeah, that is what I talk. No, he is talking about the faceless assessment.
Okay.
Yeah, so we have a separate session on faceless assessment where we'll be dealing with and how to handle faceless assessments. I think then we can conclude the session.
Okay.
Thank you, sir.
I would like to thank CMA Sukhi sir for its excellent presentation and explaining in detail various provisions of the income tax related to income tax assessment. I also would like to thank our WRC staff for their continuous support on all the participants for attending the session. Our next session of the webinar series on income tax will be tomorrow at 5 p.m. The topic covered will be income of individual to include income of spouse, minor child, etc. So I will request you all to attend tomorrow's session. With this, our today's session is completed. Thank you. Good night.